Thanks for clicking. The finances of Canadian households are starting to show early signs of stress. This according to a new report coming from CIBC Economics.
Where the are you?
Indeed, the report will no doubt come as good news to the Bank of Canada, and comes along a new report showing that Canada's labour market is also showing early signs of stress, with unemployment inching up in July. The recent unemployment data has led some to argue that the bank will be pausing on rate hikes at its September announcement. However, wage growth was also up as well, leading others to argue that the bank could in fact have more rate hikes in store. But, says CIBC Economics, the data shows that cracks are starting to emerge in the finances of Canadians, which will no doubt weigh on the minds of the Bank of Canada when it makes its September announcement. So what I want to do today is go over CIBC's report, take a look at the discussion surrounding Canada's unemployment data, and then discuss what to look for next. Speaking of next, Stats Canada is set to release July's inflation data next week on Tuesday, which will no doubt weigh largely on the minds of the Bank of Canada when it makes its September announcement. We'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. Onto the report. As mentioned, CIBC stresses that cracks are starting to emerge in the finances of Canadians as they continue to struggle with higher cost of borrowing, with consumer proposals as of late surging to pre-pandemic levels.
Because I'm successful.
Indeed. And this report falls in line with another report just released in August, showing that insolvencies have been surging. In June, there was a 19.5% annualized increase in insolvency filings. The report from CIBC also notes that delinquencies on auto loans, credit cards, lines of credit, and installment loans are all up past pre-pandemic levels. And while CIBC is using older delinquency data, that from the first quarter, the data matches what we heard from Equifax in May, which also reported continual increases in delinquencies. So, as a result of the increase in the cost of borrowing, and I'm assuming the higher cost of goods, though the report doesn't explicitly say it, delinquencies and insolvencies are all shooting upward, showing minimal signs of slowing. Further, says CIBC, the number of delinquencies are likely to only increase, as Canadians are renewing into much higher mortgage rates, with 1/3 of mortgages set to renew between mid-2023 and the end of 2024.
I've got a solution.
But the major increase in payments makes sense. 5 years ago, a decent 5-year fixed mortgage rate from RBC was 3.74. Fast forward to right now, and that is sitting at 5.54. On a mortgage that started out at $500K 5 years ago, that would equal an increase in over $400 at the time of renewal. And, all else being equal, if the Bank of Canada doesn't lower rates in the next little bit, then payments should increase even more, as rates were much lower in 2019. In March of 2019, a decent 5-year fix was sitting at 3.49, and that was down to 3.14 in September. So, unless mortgage rates come back to earth late next year, the increase in mortgage payments is going to become even more tangible. And CIBC says that these mortgage renewals, these higher rate mortgage renewals, will act to further limit the amount of disposable income entering the economy, with homeowners devoting more and more to lines of credit, mortgage payments, etc. But, make no mistake, this is what the Bank of Canada wanted to happen. This is very much part of a deliberate process. Less money entering into the economy will result in an increase in unemployment. And we saw that last week, when it was announced that Canada's unemployment rate had ticked up for the third month in a row, reaching 5.5% in July. Doug Porter, chief economist at the Bank of Montreal, said that this is just the latest in a quiver of signs showing that the economy is losing momentum. And while some are saying that the slowing momentum will lead the Bank of Canada to leave rates unchanged at its September announcement, others are noting that the wage growth is going to be a concern for the Bank of Canada, as wage growth reaccelerated in July back up to 5%, higher than the current rate of inflation.
Why does that matter?
Given that the Bank of Canada has been adamant about its intention to prevent a wage price spiral, re-accelerating wage growth, and not to mention the much anticipated wave of strikes growing across Canada, could lead the Bank of Canada to try to kick the unemployment rate into high gear in short order and raise rates again. Unemployed people don't have much bargaining power, especially in a recession. So, in summary, cracks are starting to emerge in the Canadian economy, with delinquencies up all across the board and only likely to increase as Canadians renew into much higher mortgage rates, and we're seeing an increase in the unemployment rate. With all of that said though, these are very, very early cracks. As we've talked about in another video, historically, Canada's unemployment rate doesn't move very quickly. It doesn't move as fast as maybe the Bank of Canada is hoping.
But I want it now!
And although CIBC does predict in the report that as a result of all these cracks emerging that we will see interest rate cuts by mid-2024, I'm not sure that the CPI or the unemployment rate will move that quickly. As we've talked about so much in other videos, there are a number of stresses continuing to be pushed on our CPI, and it's not clear that the Bank of Canada will be able to get the CPI back to target in time for 2024. One notion that I think is all too often forgotten is that rate cuts are not the natural order of things. Rate cuts are meant to bring the economy back to a healthy position. And in order for that to happen, the economy first needs to be in an unhealthy position. And while we are seeing signs that Canada is moving in that direction, we're not there yet. And if the pace doesn't rapidly increase, we won't be there for quite some time. With that said, we will continue to have updates out on the Canadian economy on this channel. Click like and subscribe if you want to get those updates. But for now, thanks so much for watching.